Are you guys chill as a cucumber? Because I am, and I'm hoping you are. But today I just want to talk about the stock market anxiety, the crash, the inflation rates, the interest rates, and everything else going on here, guys. And I kind of like my cool little pillow that's got the emoji. I need to get a few more of these and stack them around. But nonetheless, folks, I just wanted to have this conversation today, primarily just because there's a few things that you'll probably learn about this. I mean, it's like Warren Buffett says, when the tide goes out, you really see who's not wearing any swimming trunks. And I think it's pretty prevalent just to reiterate this before we start talking about what's going on in the markets today, because my goodness, there's a lot going on with tech. The markets went down, they went back up, the volatility continues. But first and foremost, folks, in these times, the only reason that you shouldn't have any fear is because you don't have debt, you have an emergency fund, you're not like stripped down by anything that could really hold you back in this market, even with inflation running out of control, even paying more gas. Most of you should be doing relatively okay. I hope, if you're watching this channel, because that's where most people's fear is going to be driven by. But all of that should be mitigated first and foremost by not having to worry about the stress of financing. That's why we build a storm shelter, basically, your funds, right? Because when the storm comes, which it's here, we just don't know how bad it's going to be and if that tornado is going to hit your house. I think I heard some reiterations of that from Dave Ramsey earlier. But yeah, it's just weird because everybody knows the storm is coming and it's here, and anyone pretending like it's not is just completely foolish. And it's fun watching CNBC right now because you're hearing both sides of the spectrum pretty much bi-daily, whether we're heading into a recession. Some people don't believe we are. They think the jobs market, the increasing of wages and people in the job market is going to mitigate some of this risk, but we don't know how high gas and oil prices are going. And I've been getting pretty finicky with my gas purchases because when I realized gas is just going to keep going up, I decided to fill some jerry cans. That way I can avoid touching the gas, going to the gas station for at least a month and a half while I see and hope a lot of this comes down. But yeah, guys, so we are sitting in a storm. And honestly, it doesn't really bother me all that much. And many of you know I have been stacking cash because it's fun to be able to invest a little bit more when the markets are down. But that's not a strategy most people should adhere by whatsoever. I think most people should be cost averaging into the markets and taking advantage of some of these dip buy opportunities, because clearly every day some of the markets go lower and then we just shoot right back up. But we haven't hit bottoms yet, I don't think. Every time I look at the QQQ, it hits a new low before it bounces slightly intraday. Because I'm still fairly bearish on some of the large caps. I'm really excited for Apple's Q1 earnings that are coming out. So we might as well start off with big tech here, guys, because I mean, Facebook's still trading, I can't believe it's below $200, but Apple just had an event today where they released a new chip called the M1 Ultra that they're putting in their desktop devices, which is just staggering because they're mirroring the chips together now. And it's really incredible because Intel's new chip, they delayed by like 2 years, and it's giving Apple this really core advantage in the current market for price versus performance. I already got the M1 Max Pro and I've been loving it, or just the M1 Max, I guess, in the MacBook, and it's been absolutely phenomenal. I mean, I've had 8 project files running on Final Cut Pro before I got the little spinning wheel to come up that actually decided to load the data in, which was nuts to me. But outside of Apple here, folks, I mean, it's been, every day has been fascinating. I love watching Elon Musk's Twitter right now because he's obviously tweeting that we need to push more oil production out, which is really unusual from him. But obviously, the utilities and renewable sectors have been taking good advantage of this oil shoot up as well. It seems like utilities, renewables, and energy stocks are all taking benefit to this. I mean, over the last day here, since the markets opened up, I've been go on StockTwits and you look at the trending stocks, and they're all oil companies, especially the smaller cap oils. I know Warren Buffett's got a stake in Occidental Petroleum, and those things have just been flying up off their lows. I'm curious to see if ExxonMobil can hit a new all-time high, because I mean, it hasn't hit a new time high for like a decade plus. So it's going to be neat to see what happens as oil moves higher. Watching the Canadian market as well, companies like Enbridge that have huge exposure to the oil sector, just to see what the first quarter brings in. But typically the trend is your friend. I think oil is going to continue to trend up. I'm just a little worried that if you're buying it today, you're going to get stuck in a cyclical upturn that's going to come to a cyclical downturn at some point in the future. Because whether you're worried about inflation and gas prices, this is all short-term hiccups, right? So if you're cost average investor, 20 years from now, everything we're discussing today isn't going to matter. Hopefully these geopolitical tensions, slide over, and eventually, it's just going to become hopefully not nearly as serious as it is right now. Same with inflation, because the supply constraints will hopefully start working themselves out by the end of the year. Yeah, uranium is up a lot because Russia is obviously a major exporter of uranium. Actually, one of the big problems right now that's being largely debated is obviously wheat and food prices, because the Ukraine is a huge proponent to wheat products. In a lot of the European areas and some of the African areas, I believe, in the Middle East, and apparently it could cause some food droughts, I guess, or spirals of food inflation that those people can't afford because they highly rely on cheap wheat and food products, which luckily in the Western world were mitigated from most of those issues. But this is kind of like that spiral effect, right? Where you don't think much going on in Russia could affect the rest of the world like it is, but unfortunately, the entire world is globalized. And I feel like ever since the tariff war and what went on with Trump in China, I feel like the world is trying to mitigate itself to becoming more self-sufficient again. It was really weird because through the 1980s and 90s, it was all about the cheapest way to produce products, and it was all like outsourcing manufacturing to China and all over the place. And like, I mean, considering Canada is like one of the largest oil and gas producers in the world, it's still, even Canada, most of this is getting outsourced globally. So now we're seeing the problems that come with that because people didn't want to overpay in the first place. And now they're going to be forced to overpay because everything's coming back, manufacturing is coming back to the Western world. Do you think it's better to buy the S&P or something like Microsoft, Tesla, or Alibaba for the long-term growth? Yeah, so I've only recently started proponenting index funds to my portfolio because it's just an easier place to wrap your head around. But honestly, I don't know. I'm always kind of stuck between. I have a hard time buying Apple and Microsoft right now. Tesla, Tesla's one of those companies, man. These are all companies where if you want to own them, I wouldn't try to time the price as much as I would just buy them, hold them, and then just buy more if they dip. Because if you've got a 20, 30-year time horizons, those companies have the best balance sheets on the planet, right? And that's my problem with people that are like, oh, well, Google's expensive and Nvidia's expensive and Tesla's expensive. It's like, yeah, they're always going to be expensive. We don't know how low they go. We don't know how high they go. It's just a matter of, do you want to hold on to them? Because, in 15 or 20 years, God knows the valuations will have well appreciated into the current PE ratios, and you'll probably be going much higher. So I don't try and time those companies as much, but honestly, you just kind of want to own both of them, I guess. Cost averaging of the S&P is a lot easier than trying to figure out, if Tesla's going to outperform this year, if it's going to be Apple or Microsoft. But honestly, I would look at a broader diversification set because if we're going back to a 1980s kind of market, which, oh my God, the rhythm and the way the history rhymes into the future is unbelievable. Because there's one thing I would be doing right now, which I've done pretty aggressively, is catch up on my homework from the 1980s and exactly kind of what unfolded back then. Because very similar today, leading up to that the 1980s recession, it was followed by excessive money printing and obviously government spending, which we just had similarly because of the pandemic, right? The governments were overprinting, overproducing capital because obviously nobody could have anticipated, geopolitical conflict, these continued supply constraints. So like the 1980s guys, they had the Iranian conflict, right? Which is what drove up oil prices. And historically, anytime oil's jumped up this much, we've had followed by a recession. And a lot of people are debating whether that happens again. I'm more leaning toward the side that there's about an 80% chance we head into a recession, which isn't always a bad thing. Markets actually tend to do pretty well through recession, so I don't know how the market's going to respond to this. And all a recession is, for people that are maybe a little unaware of the that kind of phrasing, basically it's just 2 straight quarters of negative GDP. And GDP is just gross domestic product sales. So when you go out and you're buying food, an iPhone, whatever, and basically when oil goes up to these prices, it obviously raises the prices of everything else. And considering all prices are rising across the sectors right now, it just kind of means people are going to have a lot less money to spend on consumer discretionary items, which means less GDP. And obviously that's kind of being combated by higher job growth, or I wouldn't say job growth, but higher wage growth. It's just a matter of, we don't know what this cyclically looks like combining it all together. And my guess is the wage growth isn't going to outpace what it's costing for the general person to live. Because right now, if you own a house, you have cash in the bank. I mean, these are like, who cares that you have to spend maybe 10, 20, 30% more on products and goods and gas? I mean, I don't feel like that affects most people, well, most of the upper class, but the middle class and lower class is getting hammered right now, like absolutely just hammered. What's your opinion on Ontario or Canadian RE? What do you mean by RE? If we do have that recession, how much of the price drop do you think we would have? Or would the government just dump rates to basically negative and save? So look, this is where the big problem, and just like in the 1980s, when oil gets out of control, this kind of comes down to a two-sided problem. It's not just the Federal Reserve or the Canadian Treasury's problem to start sucking up money that they've distributed in the economy, because there's kind of multitudes of inflation going on. There's obviously Pricing power inflation, which means if you're printing a lot of money, there's going to be more money. So it devalues the money next to it. But then all of a sudden you have commodities crisis and logistics problems. So you have this combined inflation problem, which in the last Federal Reserve meeting, the government said basically, look, guys, like this isn't just a Federal Reserve problem. You can suck up all the inflation and the interest rate hikes that you want to get money supply off the table, but that doesn't fix the oil problem. That doesn't fix the supply chains problem. It doesn't fix the other problems. So it's going to have to be a combination of the government fixing parts of the economy along with the Federal Reserve raising the interest rates. But how they go about this could be extremely costly, especially to high valued real estate markets, because what ends up happening, especially in places like Canada here, Toronto, and I'm sure this could be very similar to New York, San Francisco Bay, anywhere of these super high real estate markets, what ends up happening, right, is even though we have a supply and demand problem with real estate because there's not enough supply and there's way too much demand, what'll end up happening is if rates have to be forced up materially, which I think they will. Right now, this 0.25% basis point isn't going to fix inflation. I think the Fed's going to realize this in the coming quarter. We're going to see a lot higher rates go up. And what that does is basically a lot of people that have been home flipping, which I've seen a lot of lately, a lot of people just buying homes to flip them. Obviously, there's no money in rentals anymore. You can't rent a property because there's rental control, rental locks. I know a lot of people are like, oh, well, rent has to go up because, if real estate prices go up, rent has to, the rent has to follow in correlation to make the house sustainable from an investor standpoint. That hasn't been true in Ontario for a very long time near Toronto. So what people are relying on is capital gains. The problem with cap gains, guys, is when interest rates go up, usually typically every 1% interest goes up, real estate drops 10%, but that historically was in time periods where there was available real estate. Now there's none. So what's going to happen is everybody that owns a house right now and they just kind of started building up the rental properties or whatever, they're not going to be flipping or mortgaging the real estate into other properties because you don't want a higher interest rate, right? So if you could sell a property for, 2 million, you might want to go buy another property for 1 million or buy two properties for 1 million each, right? But now you're not going to want to do that because the mortgage rate is going to be substantially higher than the current property and the mortgage you're holding. So what you end up getting is this crazy amount of undersupply in the market. All these people that were flipping homes, offering the liquidity to the market, are going to be offering less liquidity because they don't want to flip mortgages anymore or flip deals because it's going to be too costly, let alone if interest goes up, usually real estate comes down. So there'll probably be more uncertainty around it. And whether that actually materializes into a housing correction is still hearsay, because obviously if there's less housing on the market and obviously interest going up, it's going to be neat to see how all of that unfolds. Obviously, I would like to buy a piece of property, and I think the real estate market is getting overheated. And in time, I don't know if that happens in a year, 2 years, it could be 3 to 5 years from now. But as we get much more building development, which I could imagine the red tape is going to loosen up, because a lot of the big REITs here in Canada, like RioCan, Smart Centers, a lot of the REITs that I hold are supplementing with the government to start dealing with the development problem. So I'm curious to see how this is going to unfold. But my guess, if I had to guess, I have a hard time believing real estate's going to largely correct unless we see interest rates go up very drastically, which is a likely outcome. It's how much of an outcome it's going to be, because it's really just predicting how high interest can go, is going to see how that affects on the market. And yeah, you might be able to start finding good deals because, maybe some people can't afford those higher interest rates. And yeah, they might be fixed for 5 years, but a lot of people are going to be underwater and scared what they're going to do when those interest rates come into renewal. And like you're saying, eventually what could happen is the government might have to mitigate as well. We could see the government go more into, more of a hedging, or what's the term for it when they kind of become not hawkish. Is hawkish the term? Because eventually if things get a little bit too heated and the markets correct too much, they'll stop raising interest rates if supply constraints work themselves out and other parts of the market fix themselves. But more pertainably, we can talk about stocks here as well, because from the energy, and a lot of people are more fearful that as interest materially goes up, is that being priced into the market? Because I don't know why they keep thinking it affects big tech companies and companies that leverage capital, because you think it would hinder more highly leveraged companies like small caps, which I think is going to continue to hinder a lot of the smaller caps. But the large caps, I don't know why there's a rhetoric, because, when Apple and Facebook have tens of billions of dollars in cash, can pay their debts off tomorrow, interest shouldn't really affect them. Where it should affect the markets materially is, I would think, in the REIT sector. But a lot of the REITs that I follow have been really correcting their balance sheets to really really minimize their debt. I mean, I've kind of been blown away by the debt restructuring over the last 2 years. I think the pandemic really feared a lot of the REITs, so they fixed their balance sheets and they're continuing to fix them. So I feel like the REITs should perform pretty well, whether interest goes up or not through this, because they have so much liquidity in this market. But utilities is one that I'm very intrigued by because utilities are very costly. And I feel like, they bake in a lot of the lease structure and their debts into the future. It's going to make it a lot harder for them to kind of move forward, I think, in this market if they're going to be utilizing debt. But honestly, what I've seen amongst most REITs and telecoms, well, not REITs per se, but mostly telecoms and utilities, is they're not raising debt anymore from banks. What they're doing is they're doing share dilution, which is largely debated amongst investors because a lot of people do not like share dilution because it lowers your piece of the pie, makes it harder to get equity growth down the road. But I've noticed that, TELUS has been doing that. Bell has been doing that. A lot of the utilities like Algonquin Power have primarily been doing that. And it's kind of a double-edged sword, right? Because you lose the larger share of your position in the company, but at the same time, you're not getting to deal with the debt and having to, pay higher interest rates on that capital that they're raising. So, I mean, I trust the utilities and the telecom here. It's just a weird market to try and wrap your head around some of these companies that have larger debt positions. What's your cash position like, Kyle? When are you backing the truck up? Look, my head is constantly scattered in this market right now. So I've been looking at, I don't have the guts to do it, but obviously you could swing trade oil right now. I've been largely debating it because I'm like, these companies like Enbridge, they're really cyclically traded off the oil price, and they're going to be posting phenomenal numbers probably for the foreseeable next 2 or 3 quarters at least until oil starts mitigating. But I don't want to hold them long term because, like I said, cyclically oil goes up, it comes down, and we're in that uptrend right now. And just like when small caps had their uptrend, just like when tech had its uptrend, inevitably this is going to turn around, and we don't know how low it'll drop on the other spectrum, which could be a year from now, 2 years from now, whatever. But I have been debating on swing trading some oil companies. My cash position, though, I'm sitting on a huge, huge pile of cash. Every time I look at it, I'm like, when do I start spending it? I don't know. I'm not like backing the truck up to any major degrees yet, but I'm sitting on almost $50,000 in cash. I don't talk about my cash position as often because I'm finishing up my tax season and I've overestimated the amount that I'm going to pay on tax. Right now, I'm primarily, like I said, I just want to solidify my emergency fund because if the markets do tank where I want them to tank, and obviously we've only seen the markets tank in cyclical areas. So I honestly think we're in a bear market for things like your tech stocks like Facebook, Shopify, PayPal, Baba, some of these foreign companies. There's obviously huge value potential in them. But as I've mentioned, there's no point to buying a falling knife. I do not want to buy these stocks when there has been no confirmed bottoms in them. And obviously the rhetoric is still in the position of bearish. And everyone is trading these speculative companies now off valuation metrics. You got to remember, all these spec companies were traded off, high valuation and future expectations. But now that all that hype is dead, the only thing you can trade these companies off of is pure valuation basis. And now that you got Shopify trading toward the low 20s, it's getting very intriguing. I mean, Shopify was one of Canada's largest companies. These are companies that are very hard to lose money on over the at least the 3 to 5 year mark. So ideally, what I would like to do, and this is kind of one of my bigger trade plans, is I'm trying to put a list of about 5 or 10 really kind of decent, solid balance sheet growth companies together. If I didn't own Facebook already, it'd be in that group. And what I'm probably going to try and do is leverage a decent chunk of capital. So, once I get my taxes finished up over the next month or two, I'm going to see how much cash I have left on the side, see how much margin I have available, how much I have available in my line of credit, maybe even borrowing money from like my parents. They're going into retirement. And what I would like to do is swing trade the recovery because I honestly think when these stocks start to recover, because usually they go through an overcapitulation to the downside and then they're going to overcapitulate to the upside. And honestly, I think we're well below fair valued in a lot of these companies. The only thing is I don't know when they rebound. So I would rather just wait and see what happens. And honestly, if they rebound 20, 30, 50%, they're still going to have lots of upside capability. It's just a matter of making sure that the market starts getting frothy again and people start seeing those opportunities for what they are. And then just buy into them for, a quarter or two and just let that bake in and maybe try and make a quick 20 to 50% return off the rally back. I know that was one of Meet Kevin's kind of plans, was to dump it all in at once. I'm not like heavily relying on that plan. But what I'm primarily focusing on still is using that opportunity because obviously you could make a much higher return than a dividend stock. But I'm hoping in the near term, dividend stocks start getting clobbered because a lot of my favorite dividend companies right now are starting to come back into fair valuations with things like Procter and Gamble, McDonald's, Starbucks. I love my dividend stocks, and I really like the ones that I know I can cyclically hold for 50 or 100 years, especially ones that have really great compounding dividend growth. But honestly, I don't like McDonald's at a 2% yield or Starbucks at a 2% yield. 3M is still at a good value here. It's just I'm not the big fan of the kind of the industrial material sector, but I would be really inclined to be picking up, any of these super high quality names if they drop much farther. So I'll probably start cost averaging into those companies maybe within the next quarter or two, because what I think is going to happen is Apple and Microsoft, Google, these companies that shied away from guidance in the Q4 of last year that came out in January, February, are going to be forced to show guidance. And if there's even a cyclical, if there's even a hint, even the slightest hint of slowdown, we're going to see what happened to literally every company from Facebook to Shopify, PayPal. That's what's going to happen to Apple and Microsoft. I think it's an inevitability, because I just don't see how Apple comes anywhere near close to the year they had last year, when no company in the tech sector can even post that kind of guidance. Because I mean, when Amazon's posting 3% rev guidance, which is still amazing, don't get me wrong, like these companies are making money hand over fist. I think they're great numbers. There's nothing to be scared of. It's just a matter of that little bit of slower guidance is going to scare the shit out of the market. And Apple's kind of like the last domino to fall. And I feel like once that falls, if it falls, nothing saying it does, I'm speculating that it does. But if it falls, it's going to take the rest of the market with it. We'll finally see the full bear market come into play, because right now, because Apple and Microsoft have held up so well, they're basically holding up the entire index. And because the S&P 500 index, like VOO, the SPY, they're primarily weighted now by I think 15% of the entire holdings completely rely on Apple and Microsoft. So the way to look at it is if 7 to 8% of the entire VOO is held by, say, Apple, and Apple corrects by 10, 15, or 20%, materially that's going to drop 2 to 3% of the entire VOO. So I mean, you could easily see a material it would really be a drastic effect on the overall market. And that's when I figured the full pain will have hit the market. We'll get more clear images on the Fed actually trying to fix the interest rate and the inflation problem, because I don't think it's going to resolve itself in the next quarter. And then probably by the second half of this year, I'm hoping by the second half of this year, that's when we should start seeing things mitigate more properly. There'll be a lot less uncertainty in the market. Hopefully the geopolitical issues start having a resolution here, whether that's Russia taking over the Ukraine or whether they come to some terms. Hopefully, fingers crossed. And then all of a sudden, all the uncertainty leaves the market. That's when we can start seeing a rebound in some of the tech and smaller cap plays. It really just comes down to those few defining points, right? Do we know how high interest is going to go? When do we get that picture cleared up? When do the geopolitical issues clear up? And then finally, that's when we're going to see the stock market start repricing in some of these growth vectors. Got to buy VGT when that happens. Buy when there's blood on the street. Yeah. So right now, the only thing most people should be doing is cost averaging into the market, right? I'm still holding all my plays. I'm done restructuring the portfolio. Spent a lot of time restructuring, and it's mitigated a lot of my downside risk. I've been pretty patting myself on the back for most of the money that I've saved to the downside lately. But yeah, it's just a matter of I think this market should just reiterate to people's idea of margin debt, and just because you don't know when shit hits the fan, and people got way too comfortable in the rally of the market, and even I got way too comfortable, right? Not to any major extent that if the market's tanked it would kill me, but enough that you just want to know that you can afford food and gas without ever having to sell your stocks at the end of the day. I just buy my couple $100 of SCHD every week. Yeah, I still like VYM, still like C or SCHD. Great dividend ETFs to be buying for sure. I haven't been too proponented to buying the Canadian aspect of that, because I feel like the Canadian market's still too small, but I would be buying I can't remember the Canadian ticker that's kind of like VYM. There's a Canadian dividend ETF. I think it's the BMO dividend ETF, but it holds a lot of the stocks, just the banks and things like that. Actually, I'm really curious to see how the banks respond through a lot of this, because historically in the 1980s, the sectors that outperformed during similar crises were obviously energy was number one. So obviously oil stocks, energy stocks, utility stocks. We had healthcare actually do pretty good, and healthcare seems to be doing okay right now. I think AbbVie is probably one of the outliers. It's really performing well. But yeah, I was expecting healthcare to be doing a little bit better by this point. I'm surprised that the things like Pfizer and Merck and company were trading down. So I mean, healthcare usually does pretty good in these markets. Financials typically do pretty well, but the only thing that actually gets slaughtered is tech and small cap. So I don't like always hearing people like financial education continue to drive the small cap story because you want to go where money's the easiest, and the trend is always your friend. So like, you want to have this diversified idea of a portfolio to not just be in a few specific sectors. Cause like, it's crazy, like how well utilities are doing right now. Like I haven't been green on Algonquin Power since I've been buying it. And it's been trading down for a while. And now all of a sudden it just keeps trading up week after week. And, same with Northland Power, all these renewable stocks. So, and renewables are still at a great buying point here, I think, because a lot of them haven't recovered from their cyclical lows. So, I mean, the utilities are by far one of my favorite sectors. The boring sectors are always the best because you shouldn't have to worry about these ups and downs as much. How do you go about allocation? Do you get 5% max with the individual stocks? Yeah, so that's something new that I've done. When I was kind of getting a little overzealous with tech stocks, I was making like Tesla and Facebook like 7 to 8% weightings. Usually, once things got over 10%, I'd cut them back a little bit. But right now, I'm kind of going by that Kevin O'Leary standpoint, which is no more than 5% of your net worth in any individual holding, followed by no more than 20% in any individual sector. And I've done a pretty good job allocating it that way because big tech is kind of hard to sector allocate. Because I look at kind of tech weightings, because right now I think 23% of my portfolio is in tech, but I wouldn't really call those all the same sector. Like I wouldn't say Amazon is the same sector as Apple, or Apple's the same sector as Tesla, or any of those are the same sector as cryptocurrency. So I when I say, like, when I look at my tech positions, I feel like you could own Amazon and Apple and not put them in the same tech weighting almost, or even Microsoft for that matter. I mean, they all trade and make income off vastly different sectors of the market. But yeah, so like the highest position I have right now is Ryokan at 6%. I think is my highest weighted position next to VYM, which is that ETF. So, and that's only at 6%. The only thing I would make larger positions are ETFs, because obviously you're holding a vast sector of assets. So, I mean, yeah, I mean, the only place I'd be comfortable putting that kind of money is in ETFs if we're getting into the 10% weightings. Thanks, dude. You're the best. I appreciate that. But yeah, so outside of that, though, if you're a smaller investor, honestly, I think it's just the only time you need to worry about sector allocation and percentage weightings or if your portfolio is at scale. And by scale, I mean, if you have 50 or $100,000, then I would be a lot more concerned about sector allocation. But if you've got 10, 20 grand in the market, you could easily hold 30% of that in one stock. And I wouldn't be that worried about it. I've reiterated this before, but a lot of people ask me about like risk tolerance and how you go about allocating. And honestly, if you have $100,000 plus portfolio, I would be much more inclined to divvy that up between 10 or 20 positions. Whereas if I've only got 10 or 20 grand in the market, I would be 100% in the market as much as possible, and then just keep adding money every single month. Don't worry about cash as much. Don't worry about timing the market. Don't worry about, sector allocation as much, because you just got to worry about scale, right? Because if you're making 50K a year and you're saving 20% of that, you should easily be able to put 10,000 away a year. And if your portfolio is only 10 or 20 grand, you're going to double it this year. It's going to be easy for you to double that. If you've got 100 grand portfolio and you're only making 50K and you can only put away 10K a year, I mean, you're only going to be able to put 10% of your portfolio away that year. So I would be a little bit more concerned, because obviously it's a lot harder for you to just, double your portfolio by adding capital. So if you get to that scale, you want to be more mitigated just to protect the money you have. But 10 or 20 grand could vaporize, and you could start from scratch, and it's not the end of the world. I think that's the hardest thing for newer investors to wrap their heads around, because a lot of new guys over diversify, or I feel like they don't understand their risk tolerances appropriately. Because again, you got patience, right? I mean, you don't have to wait for the markets to rebound if you don't have a lot of money, because there's just no point. So what else is going on, folks? I'm gonna I just wanted to have a quick conversation today. I think Jeremy has so much money and private portfolios that his small caps are probably less damage to his portfolio. It concerns me seeing his followers go all in on small caps. Yeah, I don't particularly like Jeremy's approach to the market. I don't like any one approach. I feel like in an early day investor's mind, you're not really fully suited to come up with your own investing strategy, because you copy people. It's like anytime you're young and you're starting a business, or you're starting a channel like a YouTube channel, or you're just doing anything, you're always copying people that are successful. So like a lot of people would watch Jeremy and think that's kind of like the end all be all, or somebody will watch Meet Kevin and think trading the markets and, you could be successful like Meet Kevin by constantly changing your mindset. But honestly, I don't think any one of those particular strategies actually works for most people, because that's what I did, right? Like in the early days, I listened to people like Kevin O'Leary, and I bought heavily into the oil sands. I bought a lot of stocks I shouldn't have bought. I ended up selling some of them at losses. So I feel like until you can start figuring out your own way in the market, it's more appropriate to take everybody's opinion and just kind of start allocating your portfolio in a manner that suits your risk tolerance, but doesn't just isn't inflicted by one opinion. Because right now, anybody that listened to Jeremy is slaughtered. I mean, they would have bought Tesla, they would have bought Facebook, they would have bought Tattooed Chef, they would have bought literally every company that's down 30 to 80%, and most of their entire net worths would have been wiped out. It would have sucked. And they would have never wanted to buy energy stocks. They would have never wanted to buy utilities. They wouldn't have cared about dividends. And it would have really destroyed them, right? Like it's just a terrible mindset. But then if you go listen to people like Everything Money, which I don't agree with value investing to 100%, Everything Money, they've literally, that main guy on Everything Money hasn't had a return out of his portfolio in 5 years. But he's going to try and sell you they try and sell you that basic, it's literally just it's just a stock screener is all as it really is, that gives you valuations on companies. And honestly, what I've learned over my years in the market is valuation doesn't always matter. You will not always make a return by valuing specific companies in the market. I know a lot of people say that the market's like, in the long term, it's a weighing machine, and in the short term, it's a voting machine. But honestly, there's so many companies that have been overvalued their entire history in the market. And very few times over the decades some of these stocks have been around, they haven't offered like fair value to buy into them. But if you didn't buy them, you missed out on some of the greatest gains ever, right? Like look at Tesla's a good example. In 2019, people said the same shit about Tesla as they say right now. And you think Tesla stock is going to drop back down to the price it was in 2019 pre-split? Hell no, it's not. It's never going back to its 2019 price. I could never see that happening in the next 3 to 5 years. So, I mean, I don't like listening to Everything Money, because if you followed their advice and you bought Alibaba and you bought Intel and you bought Facebook, I mean, you've been wrecked. You've been honestly wrecked, and it's not been fun, right? And a lot of the sectors people don't talk about, like the real estate sector has been incredible. The REIT sector has been just one of my best performing sectors right now, with utilities, the banks, the financial sectors. No one really talks about JP Morgan or the Canadian financial sector. And that's, for the last year and a half, has been outperforming drastically. And I don't think I've ever heard Jeremy or, or me, Kevin, or these guys talk about any foreign companies in Canada where the markets have been unbelievably fruitful. And I mean, the TSX is in the green. We're outperforming the US markets right now. So, I mean, like I said, when you're newer to the market, guys, you got to kind of find your own way to it and figure out what kind of exposure works best, and just kind of start learning everybody's strategy, because a lot of people do options trading as well. I don't do options, but there's huge value to it. I mean, that's something that Everything Money does. That is something that I don't think they talk about a lot, but as if you're into growth stocks, let's say you think Tesla's overvalued. Okay, well, buy a put, get some put options on it. And then that way, if it keeps going up, you can cash flow it. And if it drops to the price that you want it to be at least you can buy it when it gets to those valuations, right? And if it never does, at least you're still making money off Tesla, right? But those are more advanced strategies. I don't think options trading's for most people in the market. Options aren't pertainably for me. I see value in them, but I feel like it's a little bit more active income. And personally, I like the little bit more passive style of just buy and hold. Everything Money is dumb money. Should fight in the alley. Yeah, dumb money and Everything Money are like the two opposite spectrums of. And I don't know how anybody listens to dumb money. Listening to dumb money like is worse than Everything Money. I love them. They're entertaining as hell. I actually watched their stream today. I think the one guy that doesn't talk the most, the guy with the cap on, what's his name? Jordan. I think that guy probably has the best returns and probably the most stable portfolio, because the guy's worth more than both of them combined. He never talks about how much money he has in his net worth, but that guy's all about index fund investing, things like, super stable foundational companies like Amazon, and he was buying HP, the printer company that did well. Whereas, those other guys, they're just in the most risky assets. I think they did a portfolio reveal a couple weeks back, and I was blown away by the risk in their portfolios. Like, I feel like Chris Camello there has probably lost so much money like me, Kevin, has in the last 3 or 4 months. So it's kind of just insane, right? I feel like you can't listen to anybody. You get too caught up in hype. I think hype is what will kill you in the market. It's a kind of one of these shameful things where like FOMO ends up destroying you on every spectrum of the market. Like there's FOMO right now in energy. There's FOMO right now in NFTs. There's just so much FOMO in the dumb money kind of investing that like 9 out of 10 of those companies are going to wreck you. Like look at their early day buys, Peloton, Crocs. I mean, like, I think they were involved in Foot Locker and some of these other like retail companies, like the alcohol brands, and all of them have just gotten completely wrecked over the long term. So they're trading in and out of them a lot. But like, I'm a passive guy, right? So I want to find companies that if I'm overpaying for them today, and that comes back into your Google, your Tesla. Like if I know I'm overpaying for them, I have to be able to know that I'm willing to hold on to them for like 5 or 10 years. And I can't see that with Crocs. I don't understand retail as well because retail scares the hell out of me. I've watched so many retail stores come and go. I don't know why like Jeremy is so into like consumer discretionary. I like consumer discretionary at scale makes sense to me. So like Procter and Gamble, Clorox, what else like Scott's Miracle Grow. Those companies, a lot of those companies are starting to trade down a lot. But I'd feel way more comfortable owning one of those large scale companies that make toothpaste like Colgate than I would be buying one of these smaller cap, consumer food companies because they're just like how Tattooed Chef. I mean, I'm not into the whole vegan and like, I like them. Don't get me wrong. I like that food segment, but I don't understand, why the margins suck the worst in them. Like you're completely reliant on those segments continuing to grow and those food products expanding. Right. And I don't understand it well enough. So I don't get it. I'm just a little more fearful of that. I'm helping an Instagram influencer with her new YouTube channel. Good for you. Big money in it, man. I think when people get into social media, they underappropriate the money and the significance. I've been actually teaching my buddy's daughter about social media marketing and understanding Google ads, Facebook ads. People are so dumbfounded and I don't think they appreciate because that's how I make 6 figures a year, right? I mean, it's all off social media. It's all off Facebook pages. It's all off building out YouTube accounts. And people get into it and they don't do it long enough and they don't understand how big and how much capital can be made in this. It's kind of crazy. Think about starting a position in Starbucks. Yeah, I'd like to get Starbucks in as well. I'm just hoping it goes lower. I'm waiting for the real pain. I'm not looking for these 8 to 10% drops. I need to see like 15, 20, 30% corrections in those dividend stocks. And I'm going to be on them like you've never seen. I'll be adding McDonald's. I'll be adding Starbucks. I'll be adding Procter and Gamble. It's just, those are those core holdings like Pepsi that if you could just get them at those sweet prices, those are those, like, that's what you got to do, man. You got to make a list of all these companies, maybe focus on the indexes for the time being, like the ETFs. And then when those stocks take really big cyclical hits, sell off the ETFs because they won't be down as much and load them up. Because when you can get those 3 to 5% starting yields on these crazy large cap companies that, toothpaste, all that shit's going to be around. And those dividends, their payout ratios are great. They have lots of room to grow the payout ratio. So even if their margins get bumped, you can still have lots of room. That's the fear with Clorox, right? Like Clorox is now, they're not making enough money to cover their dividend anymore, which is kind of scary. So I'm a little more worried with companies like Clorox. I want to pay attention to those payout ratios. I withdraw a couple thousand from my cash position to buy computer, etc. I figure I'll have a better ROI than it is on the index. Yeah. So look, so when you're starting a business, right, this is a big mistake most people are going to make. It's something that I learned early on in my business after I went $20,000 in debt. I learned this very early on, and it's paid off very well for me in the future. So when I started my YouTube channel, I was using an iPhone XR and $1,000 laptop. I used that. So basically on a $1,500 investment, roughly, maybe the XR back then I maybe paid $700 or $800 for it, $1,000 laptop. And obviously I got to pay internet bills and stuff like that. But off that $1,500 investment, I was able to build a 6-figure business. It took me 3 years. Over those 3 years, I never bought another piece of business expense at all. Well, maybe, some soundproofing stuff and whatever, but really tiny investments, right? And then once I started making, 6 figures, that's when I started making bigger investments into my business because I knew the ROI would be there. So that's when I bought a MacBook Pro, spent $4,000 on that. I got mics, lighting, proper desk. I must have spent, I think at the write-off is almost $10,000, but that $10,000, like I've already got that money back, like within 2 months. I mean, that money came back real quick. But yeah, so don't, if you're starting businesses and stuff, I know it's fun to, a lot of people get caught up in the idea of building the business and making all the capital investments. And it's a stupid mistake. Me and my buddy in the early days of our business careers, we realized that if you can't make an immediate return on a business, there's no point putting money in it. Like, I mean, you should be able to go out tomorrow and make money off a business. I hate listening to like Shark Tank and all these YouTube business builders. And they just like, they just think that you have to do all this pre-work to make money. Like if you can't make money in the first, few months, then you got to be a little careful about what you're doing. And that's the scary thing with businesses that have to build out before you get a return. I like businesses where you can go out tomorrow and immediately start making money. That's like dog walking, window cleaning, social media influencing. I think you can make money very quickly on a very low expense. It might take a little more time to build it up, but I think there's opportunity with obviously affiliate marketing. People don't understand the scope of affiliate marketing very well when they get into social media marketing. There's so much opportunity, right? Just don't think you have to spend a lot of money to make a return. If I can spend $1,500 and make six figures a year, don't think you need to spend $10,000-$20,000 on equipment to get to that point. You can really operate off little. Don't spend the money until you're sure you can make it. Just some financial advice. SPAC investors are dead with no pulse. I think SPAC investors will come back. I think there's a lot of good SPACs that I like right now, like Polestar. That's going to be going public soon, I think, through what and I think that SPAC is trading at its unit value. I think in the EV market, I'm much more bullish on Polestar than I am some of the other OEMs like your GMs and your Fords. So I like some SPACs. I mean, there's still a lot of good SPACs out there. And now they're at good prices, right? Like Hyliion. If you want to buy into the SPACs that already came public that are trading down, there's good opportunity there. It's crazy how much some people can make in ads. Yeah, so ad spending is something that I've been doing a lot of. I've completely learned how Google ads work, Facebook ads. I spent, I think I spent like 10 or somewhere over 10,000 last year in ads. Yeah, the ad game's complicated though. It's a bit of a different turn, but the reason that knowing how ads work is so valuable, not only for yourself, but I mean, most businesses don't know how to do ads, right? Like I met a guy, and this guy was so incredible to listen to. This dude, he is a third-party seller for Walmart. He somehow got a contract with Walmart to run their ads on their products, a certain percentage of their products in certain areas, and he gets 30%, or I think it's 30%, it might be less than that, 20 to 30% of the commissions on all the sales. And this dude has like $1 million ad budget with Walmart. It's just nuts, man. The dude makes like six figures a month, and he just runs Google ads for Walmart. It's kind of insane. Opinion on Palantir and pins. I like Palantir a lot. That's another one of those small cap plays I put on a buying list. Let me just take a look, see where Palantir's at right now. So yeah, I put Palantir in the SPAC basket of companies that that you just, for me personally, I'd wait for a turnaround because it's hard to put a value on things like Palantir. In the next 5 to 10 years, I think they're undervalued, but in the next 1 to 3 years, they might be kind of overvalued. By living in your mother's basement, lol, get your own apartment to rent in Toronto and then try to make it work. If you can do this, then it's worth bragging. Yeah, I don't know. I think that's debatable. I mean, I can afford to move out and live on my own. I've calculated in obviously cost of expense. Most people can live on about 40,000 a year. And I honestly think it's a bigger brag for people that have actually managed to stabilize, a comfortable living place, because unfortunately in the world of frugality, when you're living in a place like Toronto or Toronto area where real estate costs multi-millions of dollars, you're not going to be taking out student loans and getting by in this world. I don't think it should be one of those things where you're like, oh, like Dave Ramsey, you should be making fun of somebody that's in their 20s living at home if you're in one of these primary markets, because I think it would be foolish for parents to kick their kids out and try and let them make it on their own in this market, because we're not in the 1990s anymore. It's not like, my parents' generation, because to put it in perspective, right? Like my parents, they managed working minimum wage jobs. My dad kicked out of his house at 18, got a job, got married, paid off an entire farm in their 30s, but like literally before they were 30. And then they had us as kids at 33. The problem now is that'll never happen. No kid that lives in a primary market is just going to go out in their 20s, get a regular paying job and afford to live comfortably, like let alone afford savings or to buy a house, right? So like in my own perspective, like I want to move out. I don't want to live with my parents anymore. Don't get me wrong. Like by all means, I think like I've well overstayed my welcome and I appreciate everything my parents have done. But me and my girlfriend are just working our lives out, and I'm going to help my parents get into retirement phase. So it's kind of timed out pretty well because I wanted to move out earlier this year. And now that my parents are retiring, I'm just going to help them move into their new retirement home. I'm going to help them get their financials figured out. And then I'm going to move down to the city with my girlfriend. And obviously we're going to be splitting expenses, which makes living much cheaper for both of us because we both have full-time jobs. We both make great money. So like, I'm not worried about like living on my own, but I just feel like most kids, I don't think Dave Ramsey's advice excuse me. I don't think Dave Ramsey's advice of kicking people out to the curb when they're in their early 20s, I think it's a big mistake. I think most parents should give their kids at least 5 years of saving, getting their education together, working through their education, maybe get a job, live at home, pay off the education, make sure they come out of school debt free, get a higher paying job, and maybe then start worrying about living on their own. Like I said, I feel bad for my generation. My generation is royally screwed, royally screwed. I've been watching TikToks actually of people leaving Toronto, going back to their homelands because obviously Toronto's primarily, we're Canada's the melting pot for the world. We have all kinds of foreigners here, a lot of people on student visas, and unfortunately, man, I've been watching kids leave and break down because if you're at six figures in student loans right now, which heaven forbid, there are a lot of people in that situation, and you've been working at a restaurant job, let's say. I mean, Canada, as an example, I know the US has been largely different, but let's say you're six figures in student loans or even 50 grand, whatever. You got your waitress job. So you're trying to make it with tips and using a restaurant. And then all of a sudden the government said, hey, we're locking down the country. You're going to go home for 8 months. So they go home for 8 months. They're making just enough to get by off government subsidies. Then all of a sudden they're like, hey guys, you can go back to your job. So that was coming into December of last year, more toward the Christmas season. People started going back to restaurants. And then what happened? Okay, they just get back to restaurants. They have half capacity. They can't make as much money. They can't make as much in tips. And then out of nowhere, the government's like, nope, we're going back on lockdown again. So now we have another 3 weeks of a month of sending everybody back home. And during this time period, inflation is just going nuts, but the government's not subsidizing anymore. Now the subsidies have run out. These people aren't making any more money at these waitressing jobs. The restaurants are still rebuilding their balance sheets. And now these people are still paying as much in debt. And they still can't, like, now all their food prices have doubled. The gas prices have doubled. Now they're paying like twice as much as they were 2 years ago when they got laid off. Like, it's just a wreck, man. Like, it's such a wreck. And I feel so bad. Like, we're blessed. A lot of people are blessed. I hope most of you are, but you can't but help but feel bad for somebody trying to make it on their own that doesn't have savings, doesn't have investments, doesn't own a house right now, because you'll never get there. I mean, just think about it. You need $300,000 in a down payment today to afford a house anywhere within 2 hours of Toronto. And that's most of Ontario, right? Like, how are you going to come up with 300 grand? Like, I mean, think about it, right? Like, it's taken me 7 years to come up with that kind of money, and I don't want to put it into $1 million mortgage. It'd be nuts. So I don't know. I wouldn't make too much fun of people that are just living at home. I honestly think it's an admirable aspect that they're taking advantage of it from the right aspect. Now, if you're sitting there just doing drugs and drinking and partying every weekend, then no, you're an idiot. You're an obvious idiot. You don't deserve to live at home. You do not deserve, the parents' help. But I'm glad that at least my parents have been seeing what I've been doing. And they're like, look, we get what you're doing, save up, get your life together. And at least, you won't be stressed out and you can live a more comfortable life. So God bless my parents. And I would do anything in return, give them any money they want. Never hesitated to give my parents money. If they ever asked, I'd give them anything they want without hesitation. Average Toronto rent is $2,100 to $2,300 for one bedroom. Yeah, I know. I'm not worried about that. I'd rather rent any day of the week. I already calculated all this. It's not like I'm just walking into this blindly either. Like, I understand the cost of living has gone up substantially. Like I said, the average person right now is probably going to have to spend about $40,000 a year, and that won't be downtown. If you're downtown Toronto, your living is going to be very uncomfortable on 40 grand a year, because let's be real, a one bedroom apartment is shit for 2,100 a month. Like, you're going to have to spend at least 2,500 to 3,000 to get comfortable living. But honestly, I'd rather move out to Richmond Hill, Markham area, somewhere in the surrounding areas. If you can work from home, then you can get at least a bigger apartment, probably 2-bedroom apartment for like 2,200 to 2,500 bucks a month. And you have a lot more comfortable living. And then once you're in that situation, like, if you can afford it, you're good, right? But I figure if you can make somewhere, I think comfortable living today, you probably want to make about 80 to 100 grand a year. If you can make 80 to 100 grand a year, you can live downtown comfortably, still save money, not have to worry about inflation. And especially if you're in a relationship, I mean, you got two people working, you're bringing in 6 figures a year, you're going to be fine. You won't have to worry too much. But yeah, so I mean, I'm looking at probably about 2,200 to 2,500 a month for a rental. And honestly, the craziest thing about this market, guys, and I want to call Dave Ramsey and ask him about this. Like, why would you buy a house for 1.2 million, which is like the average cost here? It's nuts. When you need to put 300,000 down, which is also nuts, when you could literally just come up and save up 300,000, let's just say $500,000. If you could come up with $500,000 and you could put it into a REIT that yields 6% or even 5% for that matter, you're going to be making 5,000 on every 100 grand of that invested. So that's what, 5, 10, 15, 20, that's $25,000 to $30,000 a year. That would cover your entire rent. And the cool thing is I don't know about the US, but in Canada, most places are rent locked. The government actually controls the rent. So you're not allowed to raise the rent once you've kind of got into the place and you figured out the rent structure based off like what the supply and demand is of the market. They can only raise rent by 1% to 2% a year. So it's like, what the rent's going to go up by. So it's just like, if your dividends can go up by even 1% or 2% a year from just, you buy the right stocks. I mean, you put $500,000 into REITs and your entire rent is covered for in perpetuity for the rest of your life. So that's like the big freaking double-edged sword factor, right? It's just like, I don't know how you manage that in your head. Like, why would you want to own $1 million house when $1 million invested literally covers your life forever? Forever. Like, literally, your entire lifestyle will be covered for the rest of your life. So it's so hard to, unless you have $2 million to put 1 million into a living place and 1 million into the market, because you need 1 million in the market at least to like cover those expenses, right? Like, because as soon as you buy a house, you're broke. You're house poor immediately. It sucks. It's so brutal, man. You go and buy even a condo for $500,000, and now what? So now you got to work. Now you got to work, and if you lose your job, you're not affording the property taxes, the insurance, the monthly HOA fees. You're not affording any of that. So it just seems so dumb when you can rent for 2,000 a month. I'd rather overpay for rent than be house poor. If you ever plan on having kids, you would want to own for stability. Oh no, 100%. I think honestly, everybody should own a house. I'm always on the side of owning a house over not owning. It's just a matter of, can you make it affordable? And my definition of affordable is your house shouldn't cost more than 30% of your take home pay. And then on top of that, you still need to be able to invest in the markets, and you need diversification, because most people, they have all of their money tied up in a mortgage, and I think it's the stupidest thing you'll ever do. Obviously it's worked out really well for people in this market, but I think from a diversification and risk standpoint, anybody doing it today is taking on a substantial amount of risk compared to 2 or 3 years ago. Because what I keep telling people is, look, if you went back here where I live 3 years ago, you could have bought a house for $500,000. You put 20% down. So you're gonna have to come up with 100 grand, right? Let's say real estate corrected by 30%. Whoop-de-doo. On a $400,000 mortgage, you might be out 100 grand. Okay, who cares? You can work that off. You can come up with 100 grand and pay down the mortgage within a year or two, right? Like, if you're working hard and you're saving money, it's easy. Now, let's say in the market today, a house where I live is over $1 million, but let's just say 1 million to make it easy. So you're going to come up with 20% down payment. That's $200,000. You're going to be left with an $800,000 mortgage. Now, what happens if real estate corrects by 20 or 30%? Now you're out hundreds of thousands of dollars, and you cannot sell yourself out of that mortgage. You're stuck in it, and you can't make back hundreds of thousands within a year. So I feel like getting into the real estate market now is more riskier than it's ever been, because most people can get royally screwed if real estate materially corrects. And that's something that scares the shit out of me, because it's nuts what's happened here, guys. Like, it's really risky, and I wouldn't want anybody getting involved unless they can absolutely afford it. And like I said, my definition of affording it is no more than 30% of your take home pay, and you have diversification, and you have maxed out your retirement funds, you have other income assets just to protect yourself, because I don't think most people could handle a 30% correction in the real estate market. Does that happen? I don't know. Do interest rates rise like they did in the 1980s and we see a major housing correction? I don't know. It's too hard to tell, but those are risk factors, and what you have to do is always pretend the worst case scenario. I always go back to pilot training when I used to fly planes, and it's been like the best thing I ever learned about investing is there's always risk. The risk with cash, guys, is you have inflation risk. The risk with buying stocks, obviously public volatility risk, cash flow risks. Buying real estate, there's interest risk and mortgage risk. There's like job risk. There's risks with everything. So you need to always understand what would happen if I lost my job. How long can I afford the house for? What happens, you got to be well aware of every defining risk factor and make sure you can handle it, because that's where the stress gets mitigated in these markets. Because if you're stressful right now, it's probably because you're over leveraged. You should be able to afford, interest rates going up. You should be able to afford inflation, like making sure that if food doubles, you can still afford to eat and pay your rent. There's so much risk that people just never take into consideration. If you own $1 million mortgage, if it corrected by 30%, are you okay? If the answer is no, then don't buy the house. It's as simple as that. We even going to talk about grocery prices? I don't want to talk about grocery prices, man. Every time I calculate my food prices, I'm always just adding an extra few $100 to it, because, wheat's over doubled. Food prices are insane. Gas is going to push food even higher. Are our REITs here overvalued? No, I think our REITs are still undervalued. I think they're great buying opportunities. I would look at RioCan, Smart Centers, Allied Properties Trust. You can even get into the healthcare sector with NWH, Northwest Health Properties. There's a lot of small cap REITs that have done very well in Canada. I think they're undervalued primarily because two things that they've done. If you look at the earnings and revenue, first and foremost, the revenues have fallen off. So they're not making the same revenue they were before the pandemic. But what they've done is they've mitigated so much risk. RioCan actually lowered the dividend, which pissed a lot of people off, but I think it was a genius thing because now they have a lot more liquidity. Their payout ratio is in the 70% range, and they actually re-increased the dividend a bit. So I think they have a lot of room from the payout standpoint. But the thing that I like most about it is they paid down their debts. So from an asset to liability standpoint, they've really made their, like a lot of these REITs have made their balance sheet way more robust. And the best part of it is the liquidity, right? So RioCan has sold out most of their projects for the next 3 years. So to 2025, all of this residential, all of these condo units, all of the development, which there's like 30,000 square feet in development coming online, almost all of it is pre-sold. So we have all of the future pre-sold. So that's great. No worries about selling those projects and renting them out and getting tenants. That's great. So we have a little bit of a revenue decrease, but where that gets made up is obviously in the asset increasing. So look, the problem with real estate investment trusts is the same thing that happened in March of 2020, right? So they corrected dramatically to the downside, even though real estate kept going up. So REITs do not trade off the fundamental asset value. So if real estate goes up 100%, the REIT price doesn't go up 100%. You think it would, like oil stocks do, but it doesn't, right? But what this does is now that we're back to where we were 2 years ago, like RioCan's fully recovered, smart centers are back to where they were, flatline stock price. But the cool thing about this current market is real estate is up by 30, 40, 50% in most areas where they own their real estate. So that means if they want to sell properties, if they want to get liquidity, if they want to refinance their debt, they have a lot more underlying asset value to refinance it, right? And I think most of them today still trade below NAV value. So you're actually buying, like I'll tell you right now, like one of my favorite things about REITs is, let me just use RioCan as a quick example. What's the current market cap on RioCan? So right now it's $7.6 billion. So if we go into Yahoo Finance and you just look up the financials and you go into the balance sheet and you take a look at the assets, their total assets sit at 15.1 billion. And if you minus it from the total liabilities of 7.2 billion, that gives us what? Are we below NAV value? So that gives us almost $8 billion. So, right now, RioCan's market cap is actually still, and I don't quote me on this because I think it's off by about $1 billion, but right now, RioCan's market cap is worth less than their actual underlying asset value. That's how you know you're buying a REIT at a cheap valuation. Because like I said, the REIT value, the stock price doesn't trade under the underlying assets. So if you can buy a REIT where they have more asset value than the market cap, minusing their liabilities, you're getting a deal. Presuming they have good, tenants. And what I love most about REITs too is, let's say you want to buy Amazon, but you want to get dividends off Amazon. So what you do is you buy the REITs that partner with Amazon. So that would be Stag Industrial. Stag Industrial's largest tenant is Amazon. Look at smart centers. If you think Walmart is going to be around forever and you like Walmart, well, Walmart doesn't pay a great dividend, but smart centers pays a 6% dividend, and over 30% of their entire income comes from Walmart because they lease the properties to Walmart on a triple net lease structure. So like, it's such a great way to get exposure to these really mega cap industries, but without, with getting a really great dividend yield and at a much better valuation. Because I think the real estate not only is up in value, but Walmart's not going anywhere. They're going to pay the rents, and you're not overpaying for Walmart. So you get exposure to Walmart, but without overpaying for it. Do Americans get the withholding tax on RioCan? Yes, you will get withholding tax. So you got to be a little careful how you go about that. The problem with the US is you guys don't get the same benefits to tax advantage accounts as we do. So in the US with your Roth IRA, you get penalized if you pull the money out early, which sucks. So what I usually recommend is if you're buying foreign stocks, to buy them in tax advantaged accounts, because that way you're not paying the full tax on them, because REITs are taxed at the highest amount, because obviously REITs are counted toward regular income. It's like you actually own a piece of the tenant. And because you own a piece of the tenant, you don't get discounted income like you do with regular dividend stocks, like the banks, let's say. So you want to make sure you have them in a tax efficient account. But the only problem is like, I feel bad for you guys in the US because Canada wants you to be rich. Like Canada, the more I look at how the government set up our tax advantaged accounts, they want you to be rich. The TFSA is tax-free income in perpetuity for the rest of your life. And the RRSP, guys, even though you have to pay tax on it when you withdraw, you don't pay tax up front, you get tax deductions. And if you buy a US stock, you don't pay any withholding tax. I don't know if you get the same benefit in the US, but it's something to look into. because then maybe you could buy Ryokan and pay zero tax on any of the income, but it's highly debatable. I prefer Montreal through real estate is still more affordable. Yeah, if you want to actually buy real estate, you're gonna have to go out to some of the outskirts. Like you have to be able to be comfortable in some of the smaller cities, like anywhere out east, Edmonton, Manitoba, Montreal, Newfoundland, those places. Why not just buy VDY if you want monthly dividends? REITs pretty pointless, I think. No dividend growth. Yeah, well, no, there's dividend growth. It depends on what REITs you're buying, right? Like there is growth REITs. Like if you want to outperform the market, go look at Canada, CAR.UN, Canada Apartment Properties Trust, Canada's largest REIT. It's outperformed the market. It does great dividend increases. The dividend starting yield is much lower. I mean, MPW Medical Properties Trust, US REIT, increases the dividend every year. Stag Industrials increase the dividend every year. I mean, you get a lot of good dividend increases depending on the lease structures, because a lot of these companies bake in the dividend increases by doing inflation rates into leases. So basically, like MPW, they have it baked into the lease structure that they're allowed to raise rents 1% to 2% every year. That 1% or 2% gets passed on to the shareholders in the dividend. It's pretty great. Honestly, though, it depends on what you want, right? Like I don't like, let's say, VDY or VYM as much because I want cash flow today. And being able to reinvest cash flow does have a lot of upside opportunities, right? Because what people might miss out on is opportunity cost. So let's use my tax advantaged account as an example, right? If I only bought, let's say, the S&P 500 index or even VYM, I'm only getting like what on the S&P 1% and on VYM, whatever, like 2 or 3%. That's not a lot of money to reinvest, right? So let's say instead I buy something like a Ryokan, which I bought at a great price because I do get capital growth out of it as well. But let's just say I'm able to get a 6% yield off a stock. Well, if I'm able to invest, say, 100 grand at 6%, that's 6,000 a year that I can reinvest. And what I've done in the past is I use those dividends to buy my speculative plays. So I would use those dividends to buy things like MindMed. When I was trading Alibaba stock, I used dividends and I actually got good returns. I mean, MindMed like had a 500x return for my portfolio and I used only dividends to fund it. So I think cash flow, if you need it today, it's a good proponent to a portfolio, right? That's why people buy option ETFs. A lot of people don't care. Like obviously, if you don't care about trading and you're just a cost average investor and you're just buying index funds, then by all means. But if you're somebody at retirement and you want that extra added income, or you're looking to, take risk off the table and use the REIT dividend income to fund other investments, it's a pretty non-risk way to invest in high growth. So let's say you want to buy Apple or Tesla and you have 100 grand, where you say, hey, I trust this REIT more than I trust this overvalued stock. So what I'm going to do is buy the REIT and then use the dividends to fund my high growth positions. So that way my high growth comes at zero risk outside of the risk that I get with the REIT. True, but total returns will always be more for, say, than VOL, VTI by an astonishing amount, right? Yeah, so total returns, in my opinion, matter more than dividends. Dividends aren't tax efficient. Obviously, like, when the markets have gone up 20% in the last year and you're getting like a compounded growth rate out of VOO of 16%, which has been the historical for the last 10 years, obviously total returns matter more. But it's a balancing act. It's always going to be a balancing act. It's the hardest thing investors are going to have to manage. For me personally, because like I said, I want to move out. I'm going to have more bills. I like using my dividends as part of my emergency fund. So typically you want 6 to 12 months of an emergency fund. So the way I structure that is I look at it as, okay, what would 6 to 12 months be? If I'm looking at spending about 40,000 a year minimum, then obviously I want to get 6 months would be about 20 grand. So I'm going to put 20,000 aside that I can always have access to as a pure emergency fund. But what I can do is I have $10,000 in annual dividends coming in, and I'm pretty reliant that those dividends aren't going to go belly up. The entire world would be busted. Like it'd take an insane depression. You wouldn't worry about stocks anymore if that happened. So I can look at it as, okay, well, if I have 20 grand and I'm going to be making another 10 grand this year, that means my emergency fund is realistically around 30 grand. So I like using dividends as kind of an emergency fund backup. And it's also great too when the markets tank, right? Like right now when the markets dip real heavily, those dividends allow me to put extra capital into the market when I wouldn't otherwise be able to. So like I said, it's a balancing act because I own Tesla, I own Facebook, but unfortunately you get into these cyclical years where you won't get growth. And honestly, everybody says they're a growth investor until growth slows down. And that's what's happened, right? Like everybody's flooding into oil stocks, all of these consumer discretion or staples. People are flooding into things like MO and BTI and all of these tobacco companies and anything that pays a high yield. All these REITs have rebounded, telecom, all of these high yielding stocks are just rebounding like crazy. So you can get the best of both worlds. You can make a really great return and have a dividend yield. Like look at utilities. Utilities are shitting out 4 to 6% yields and they're pushing back toward all-time highs. So if you're buying those cyclical dips, you're literally getting the best of both worlds and you're probably going to outperform the market. Like literally go look at TELUS. TELUS pays a 4% yield. When I was buying it, I think I was getting almost a 5% yield. And what's it up right now? Like TELUS stock, like this stock has been a printing machine. Like, yeah, look at that. So TELUS is up 11% year to date, and the yield on it is at 4%. So if the market's just flatline from here, your return has already been 15, 16%. So you can't get the best of both worlds. But yeah, I don't know. Like I said, I think it's a balancing act for sure. I benchmark VYM, CHD, and so many dividend ETFs for total return. And over the 10 plus years, no one was anywhere close to VOO or VTI. I'm making 280%. Yeah, for sure. But look at the way I structure my portfolio, right? Is look, most people should buy index funds, but I don't get my total return from indexes. I get it from buying Apple, Microsoft. Like that's where I've outperformed the market. So even though, like, say, Northland Power, or maybe not the best example, do I have any stocks that are flat? Not really, but if I had I don't think I have any stocks that are flat or I'm down on right now. I think most of them are in the green, but typically the way I looked at it is I want to get a percentage of my portfolio at a high yield, and then I'll outperform the market with things like Apple, because Apple's given me like 1,000% return. That Apple stock has outperformed VOO. Tesla has outperformed VOO. Facebook, I think, is going to outperform VOO in the mid to near term. So 3 to 5 years, I'm going to make a bet. If you're buying Facebook today, you're going to get a better return than you are buying VOO, right? Most people should buy the indexes. Sure. For me personally, though, I look at it as my growth stocks will make up for the lack of growth that I get from my dividend stocks, but that's how I outperform the S&P 500. So, you get this balancing act, right? And right now, TELUS is outperforming, like these dividend stocks are outperforming the S&P 500. So, like I said, it's a tricky game, but honestly, if you can pick dividend stocks you think will outperform that pay high yields, you've captured the best of both worlds. And then if you have growth stocks on those cyclical years where they don't perform well, your dividends will outpace that. And on the years where they do perform well, you're going to be outperforming the S&P 500. Don't do that. Don't do that. That's my strategy. It's worked well for me, but I'm also been very lucky, I guess. Past 10 years are lowering interest rates. No, yes. So that's another thing to take into consideration. In our lifetime, in my entire investing career, I've never seen historical interest rates go up in a material way. For the last 30 years, interest rates have really done nothing but go down. So for the first time ever, we'll see what happens as interest rates go up. Algonquin Power popped off today, 404 shares at 1780. Congrats, man. That's a great price to get into, because I think Algonquin Power is pushing back toward, what is it at, like 19 an ounce, or an ounce, I'm thinking gold, $19 a share. Yeah, I mean, it's at 1936. Like, I'm just starting to print off my Algonquin Power. I started buying Algonquin over the last 6 months, and only just now it's green in my portfolio. But really easy buy. I mean, Algonquin Power has been trading down, so I've been buying it. I mean, they're great companies, and they've been trading off their highs for a while now. So I think we're going to see those continue to go up. I can't see it not, like, it should easily be over $20. I wouldn't be surprised if in the next week it's over 20. But outside of that, folks, fun little conversation today. I hope you guys enjoyed it. Let me know what you think in the comment section below, and maybe I can get back to you guys after this. But yeah, what a wild market we're in. And just remember, guys, in this market, there's only one thing that is going to make you extremely wealthy, because trust me, these are the buying opportunities of a lifetime. Just make sure you have an emergency fund. Make sure you have no debt. And if you have a good job and you're frugal and you're maybe living at your parents', or you have a very reliable, stable living circumstance, you are going to be propelling yourself into the future in a way that you can't truly appreciate. And I went through this in the March 2020 crash, and I'm hoping a lot of you are going to see the same kind of result. Because basically, guys, my entire portfolio dropped 30% in March of 2020. I only had $100,000. And because of what we came out of, which is going to happen again, I promise you right now, all of these stocks that are getting slaughtered, Facebook, PayPal, Shopify, McDonald's, if it keeps dropping, Procter & Gamble, all these great companies, if they continue to drop, just buy, because when they rebound, you're going to go back to a place that you could not possibly imagine. And it might take a year, it might take 2 years, it might take 3 years. But I never thought my portfolio would go from 100,000 to over 300 grand in literally a year and a half. When markets downturn, that is when you get rich. Don't look at your portfolio material dropping. Just go out, do your yard sailing, and just buy what you can, because trust me, things are going to come back around inevitably, and you're going to do very, very well. Holy moly, should I sell my gold? Maybe keep gold as a percentage of your portfolio, man, and just diversify, diversify, diversify. But I promise you, this is going to be a market where in 2 or 3 years, I really feel like we're going to head into the next big bull phase. We are not outside of this great growth vector. As I mentioned in the past, we are in the greatest technological jump in your entire lifetime. You're never going to experience this again. Do not sit on your hands. Like I said, guys, we're never in a lifetime. Is healthcare, financials, the auto sector, it's never going to change again, ever in your lifetime. I mean, think about it. How long did it take for us to go from an internal combustion engine to an electric vehicle? It's taken over 100 years. We are not in the next 100 years going to go from electric vehicles to something else. We are not in 100 years going to go from blockchain to something else. We're not in 100 years going to go from mRNA and genetically modifying pig organs to suit into your body in the next 100 years. This is going to happen once in your lifetime. We are in the greatest technological jump ever. I'm promising you in the next 3 to 5 years, this macro event is going to be a null story, because like every event in the past has been, it's just going to be a blimp on your radar, and you're going to come out of this financially more well off than I think you're anticipating. So just always keep that in the back of your mind. No matter how bad these macro events get, when we get to the other side of this, we're still in a technological boom, and that is going to lead to incredible growth rates within certain sectors of the market that you want to be a part of, which is almost every sector. Like literally every sector is shifting right now. So make sure you're allocated correctly and don't miss this, folks. Crypto or stocks long-term, both. Do both. If you want free Bitcoin and you live in Canada, use my referral link below. I promise you, it's Canada's largest Bitcoin trading platform. They give for every $100 deposited with the referral link, you get $30. I get $30, and you can shake your phone every day and get free Bitcoin. I'm not going to say any more, but stay cool, stay awesome, folks. I look forward to catching you in the next one.